Time to cut some firewood.
Okay, welcome back. Today we'll be talking about property, plant, and equipment. So I came down here to cut firewood out of this log behind me. Just threw the chain off of the bar, and now the chainsaw's down. I forgot my tools at the house. I didn't bring them down with me. That's the problem when I bring down camera equipment and work equipment at the same time. I end up forgetting something. So I brought all the camera equipment. I did not bring the equipment for the chainsaw. So I'll have to come down and do that at a different point in time. But in the meantime, I did want to introduce property, plant, and equipment. So property, plant, and equipment. Generally what we'll be covering acquisition. So when do we record it and how do we record it? What costs go into it? This is similar to like what we talked about for inventory. Which costs go into inventory? We're going to start by talking about what costs go into property, plant, and equipment, what gets capitalized, what does not get capitalized. We'll move on to valuation in terms of what amounts do we put in for the property, plant, and equipment. And then we'll talk about kind of costs subsequent to the acquisition, so additions, improvements, etc. And then lastly, we'll be talking about disposals. So that kind of lays out this section that we'll be covering. We'll see when I kind of have different breaks here, but that'll probably be the next 3 or so sessions. We'll be covering those topics on property, plant, and equipment. So to get started, understanding property, plant, and equipment and its related costs. So property, plant, and equipment, they're assets of a durable nature. Other terms that are commonly referred to is plant assets or fixed assets. Fixed assets is probably the most common, actually probably even more common than property, plant, and equipment. Although property, plant, and equipment is the terminology that's used more recently. So there are 3 primary characteristics of property, plant, and equipment. One, it has to be used in operations. So these are durable assets. They have to be used in operations, not for resale. That's a big distinction. Right? That's what separates property, plant, and equipment from inventory or from investments, is those items are held for resale with the goal of making more when you sell them than when you bought them. Property, plant, and equipment does not have that. It is used in operations. There's no goal of reselling it for more than you bought it for. It is a productive asset. They also have to be long-term in nature, since we can't short-term, say, supplies, expenses, or other things that we expense because they don't even last a full year, generally get expensed. So property, plant, and equipment has to have a durable nature. It has to be long-term. Generally, that's over a year. Practically speaking, it ends up being probably more than at least 2 or 3 years. Things that you're going to use up just in the course of like a year or 2, oftentimes, unless they're large, go just to get expensed as incurred. And then lastly, it has to have some physical substance. These aren't intangibles. Intangibles have an entirely different set of accounting standards and accounting pronouncements. These have physical substance. So some examples of this, we have land, structures, and buildings, and then equipment. Those are the biggest areas that we'll see. And for the most part, a lot of the accounting, especially the acquisition accounting, is very similar across those items. So when we acquire land, we record the acquisition of property, plant, and equipment at historical cost. So this measures the cash or cash equivalent price of obtaining the asset. Now we say the cash or cash equivalent price of obtaining the instrument. Now it doesn't mean we have to buy it for cash, which we'll see at a later point through these lectures. We can trade assets at the same time. That doesn't mean we're not acquiring something. So we're obtaining this asset. The cost includes the cost of acquiring it, bringing it to the setup, and getting it ready, or bringing it to the location and getting it ready for its productivity or for its production ability. And all of those costs go into the acquisition cost. So this is a historical cost perspective. We don't take the current value or the resale value or the market value of any of these assets. This is a historical cost perspective. Now, we start out, we're going to walk through kind of land and buildings and equipment. And part of that's why we're going to do that is because that's generally kind of the process. So if you think about, I'm going to start a new production facility. I'm going to start by acquiring land, and then I'm going to build a building on it, and then I'm going to fill it full of equipment so I can produce, let's say, chainsaws. Since I seem to have lots of problems with chainsaws, let's produce a chainsaw that doesn't break down all the time. So we're going to start by buying the land. Now, what costs go into the value of the land? The overarching principle here when we deal with land, building, and equipment, the costs start at the point you start the process. So as soon as I start the acquisition of the land, all of those costs are going to get capitalized into land up until the point that the land is ready for use. Now, land becomes ready for use when it's ready to build a building on it. So everything from the point of acquiring the land, all the costs from the point of acquiring the land, right up until it's ready to build a building on, those all get capitalized into land. And at that point, I start capitalizing things into building, which we'll see in a second. So typical costs that includes, we include the purchase price, closing costs, attorneys, any recording fees associated with the acquisition of the land. And it also includes land improvements such as grading, filling, draining, clearing. So if I buy a piece of land that has a bunch of trees on it, and I need to cut them all down and bring a bulldozer in and flatten the land, flatten the parcel out so that it's even conducive to putting a building on, all of those costs are included in the price of the land. It's getting the land ready for the building. So anything else like assumptions of liens, mortgages, encumbrances, anything we have to pay off to get full title to the land also gets included in the land. And any other land improvements that I haven't already mentioned that have an indefinite life. Now, if they have a definite life, like if we're actually building, say, parking lots or something, well, those are definite lived items. They don't go into land. They actually go into land improvements, which is kind of like, it's not a building, it's not land, it's a land improvement. And again, those are things with a definite life. So a parking lot eventually is going to wear out. You're going to have to replace the parking lot. But if I flatten a piece of land, the assumption is that the land is now flat, and anyone who wants to buy that piece of land wants it flat to build a building on. So that's why it's under the cost of the land itself. So those are the costs of the land. Moving on to the cost of the building. So the building includes all expenditures related directly to the acquisition or construction. Again, we start with land, we get the land ready for the building. Once the land is ready for the building, then the building costs start. So that's going to include everything from designing the building to the foundation. And let's see, design the building, start the foundation, any permits associated with putting the building up that we have to pay, any taxes specific to building the building that we have to pay. All of those goes into the cost of the building. So that includes materials, labor, overhead costs, everything during construction, professional fees, building permits, everything. It all goes into the cost of the building. Now, we capitalize all the costs of the building right up until the building is ready to start putting stuff in it. Just like land, we stopped capitalizing land costs when it was ready for the building. We stop capitalizing building costs when it's ready for equipment. The idea here is that if we were to just to acquire a building, it would have all that stuff already in it. Or if we were to acquire land and all we want to do is build a building on it, the land should be ready to go. The building should be ready to go. So once the building is ready to go, the building costs stop and we start capitalizing the equipment costs. And that's what we're going to put into the building. So what costs do we put into equipment? Again, the overarching principle, all the costs from the start of paying for the equipment, the whole way through the time the equipment is ready to start producing, so that when it's ready for use. So as soon as the equipment is ready to use in our production, then we stop capitalizing the cost of the equipment. So that includes the purchase price, freight handling charges, insurance on the equipment when it's in transit or when it's being set up, any kind of special changes we have to make to the building, and whether that's extra foundation work, whether it's additional electrical work, running electric to the equipment, all of those get capitalized under the expenses, or sorry, under the equipment category. So even the whole way through running, say, trial runs of the equipment, if it's a trial run, the equipment's not ready to produce yet, we're testing it. Any of the testing process, those costs also go into the cost of the equipment. We stop capitalizing equipment costs when the equipment itself is ready to use, or when it's ready to start producing the goods in which it's producing. So as soon as the equipment is ready to start producing chainsaws for me to sell to customers, that's when I stop capitalizing the cost of the equipment. And from there on out, everything, essentially all of our fixed assets or all our property, plant, and equipment, we just start depreciating it into the costs of, in this case, the chainsaws. We might be depreciating into an expense if it's, say, an office building or something. So those are the costs of the equipment. Now, that's the cost we capitalize. Now, there's some other things associated with self-constructed assets. So a lot of assets that we get, we acquire the asset. So we say acquire the building, or we acquire the land that's ready to go, or we acquire the equipment and we're not building the equipment ourselves. So there's some additional things with self-constructed assets. So in general, think of like we're building a building. There's some other costs that we need to how we treat those that we're going to walk through. So for self-constructed assets, you are allowed to capitalize the materials and overhead on self-constructed assets. For instance, it's probably easiest to think about this in terms of, let's say I want a new piece to my production line. So I had something before, and I'm going to build a new piece of equipment on this production line. And to do that, I'm going to use my own staff to do it. They have the expertise, and they're going to do that. So the staff, or let's say maintenance personnel, who would typically kind of be overseeing this, I'm going to charge all of the materials and the direct labor, so the direct labor of those people, to that new piece of equipment. Also, just having those employees costs money. I have to provide them a workshop. I have to provide them their tools and their training and HR stuff, and all these other overhead costs are associated with just me having those employees. Well, those are overhead costs. I can apply those overhead costs also into the self-constructed asset. So that can either be done, typically it's typically done as like a kind of an overhead rate per employee. There's not a ton of detail usually done in this. As long as the company can support it, it's accepted. So however, the limitation is that the overhead cannot cause the total cost to exceed directly purchasing the piece of equipment. So if I could buy the piece of equipment for $100,000, I can't charge materials, labor, and overhead over $100,000 because of the overhead associated with that. So I'm kind of capped at what the cost of actually acquiring that might be. There is no requirement to capitalize overhead. Companies don't have to try to calculate it. However, most of them do because, well, frankly, it's good accounting. If that is indeed costs associated with that piece of equipment, then it needs to be capitalized. So that's good accounting. So that's generally done. So now, if we're self-constructing an asset, for instance, let's say there's also going to be interest costs. We borrow money. So if we're building a building, we'll go back to a building because that's a big item, requires a lot of money and a lot of capital up front. And a lot of times that money is borrowed. Now, the question is, well, if we borrow money to construct this building and we haven't yet started using the building, is that a cost of the building, or is that just interest expense that goes to the income statement? Well, it's part of the cost of the building. Now think about it this way. If I had purchased that building, I would not have incurred the interest costs associated with constructing it. I wouldn't have to start paying interest until I acquired the building that was ready to use. So it's just kind of balancing this out. So if you have interest costs associated with the building of a building, you capitalize those into the cost of the building, again, up until you're using the building. And once you start using the building, you stop capitalizing the interest costs, and then it goes to interest expense. Now, the interest costs that we capitalize, now this is consistent with historical cost, and we consider 3 items. One, it has to be a qualifying asset. So it has to be an asset that we're going to capitalize to begin with. And then we have to figure out what the period is. So over what duration or what period of time are we going to capitalize these interest costs? And then how much do we get to capitalize? So those are kind of the 3 considerations we take into account. So from a qualifying asset perspective, well, it requires a period of time to get the asset ready for its intended use. This is why a building is a good example, because if you're constructing a building, it's going to take time before you can use the building. So it has to be whatever, a property, plant, and equipment, and it has to have some period of time in terms of before it gets ready for use. When we're talking about property, plant, and equipment, we're only going to talk about assets that are under construction for the company's own use. Now, if there are constructed assets the company is planning on selling, let's say you're in the business of building buildings, Well, you also get to capitalize the interest associated with that, but it doesn't go into property, plant, and equipment. It goes into inventory because you're basically going to be selling that. So that is a cost that's associated with the production of the good, in that case, buildings. But for our purposes, we're dealing with property, plant, and equipment. So we're going to be focused on assets under construction for the company's own use. So now we're going to deal with the capitalization period. So when do we start capitalizing these expenses? Well, we start when the expenditures for the asset have been made or have started. That's when we get to start capitalizing the expenses, and that's when we start to get to start capitalizing the interest associated with those expenses. And we get to do this for during the period of, say, construction. Once the equipment is ready to use, we stop capitalizing the interest costs, just like we stop capitalizing the other costs associated with the asset. Now, this brings us to the amount to capitalize. How much do we get to capitalize? Well, we get to capitalize the lower of the actual interest costs, i.e., if we have no debt as a company and we have no interest costs, well, then there are no out-of-pocket interest costs. We don't get to capitalize fake interest that doesn't exist, that we never paid. So we can't capitalize interest that we didn't actually have. So first of all, we have to have some interest costs in the company. So it has to be the lesser of actual interest costs, or if assuming we do have interest costs, it can't be more than what we would call the avoidable interest. The avoidable interest is the amount of interest cost during the period that a company could theoretically have avoided had it not acquired the asset or not built the asset. So those are the avoidable interest costs. So if a company borrowed, say, whatever, $10 million, and they're building an asset that only is going to cost $1 million to build, then they don't get to capitalize all the interest costs of the 10 million. They only get to capitalize the interest costs associated with the actual amount that they incurred on the costs of the constructed asset. So that's the idea that we have behind avoidable interest. So let's take some examples and work through this. So in terms of capitalizing equipment, before we move into this example, or capitalizing the interest costs before we move into this example, there's kind of a series of costs that we're going to do when we talk about avoidable interest. Avoidable interest starts with if we have specific loan that we took out for the construction of that asset. Well, those interest costs, they get taken first, or they get capitalized first, because that is explicitly. So if we're building a building and we took out a loan, a construction loan for this building, the interest costs associated with that construction loan, they get capitalized first because they're directly associated. Now, if we have other debt of the company not directly associated with the construction of this land or this building, if we have other debt, we do get to use that after we've used up the full part of the specific item. So with that, let's launch into this example. So let's assume a company's borrowed $200,000 at 12% interest on January 1st of 2017 for specific purposes of constructing special purpose equipment to be used in its operations. So here's our specific loan. So this 12% loan is for this specific piece of equipment. So essentially what we're going to end up doing is all of that expense is going to, or all of those interest costs are going to get capitalized. Now, the company also has other loans out as well. And some of that interest expense some of that interest costs will also be capitalizing as well, because the piece of equipment is going to cost more than $200,000 to build. So here's our actual expenses for 2017. We had $100,000 on January 1st, so that was outstanding for the whole year. On April 30th, we had another $150. On November 1st, there was $300. And on December 31st, there was $100. So our total expenses for the year were $650,000. And there's the specific loan, the 12% $200,000 loan that was specifically gotten for this piece of equipment. Also, there's $500,000 of bonds payable at 14%, and there's $300,000 of notes payable at 10%. So that's kind of the debt of the company that we'll be taking into consideration when we, calculate the total interest of the company. Remember, the capitalized amount can't exceed the total. And when we start boiling it down to how much do we actually get to capitalize? So we'll work through this example. So, first we're going to determine which assets qualify for capitalization. Well, Special purpose equipment qualifies because it requires a period of time to get ready. So it's durable equipment, and it has a period of time it has to get ready. So it makes sense to actually have interest expense, because interest expense has a duration or period of time. Now we have to determine the capitalization period. Well, it starts when we started construction on January 1st, and it ends when the equipment was ready to go, which was December 31st. That was our last expenditure. The equipment was ready to go at that point in time. So there is our period of time. Our capitalization period is 1 year, and now we have to figure out, okay, well, what are the costs of the expenditures associated with the construction of that asset? So I'll put up a slide here laying out the expenditures that we just mentioned, and then the capitalization period. Now that's the percent of the year that they're outstanding. So obviously the $100,000 that we had on January 1st, that was outstanding the whole period, so 12 out of 12 months for that amount. So if we have a weighted average, that's $100,000 because it was the whole year for $100,000. The April 30 payment was outstanding for 8 months, November was 2 months, and the December payment wasn't outstanding at all for the whole year. So when we calculate out the weighted average accumulated expenditures, we end up with $250,000. So over the course of the year, weighted average, we had $250,000 worth of expenditures associated with the construction of this asset. That's the amount that we are incurring interest on. Now, the next step is, okay, well, what interest do we capitalize associated with that $250,000? Now, and we figure out, well, what rates do we use? There's 3 rates here. Remember, there was the specific debt we got that had one rate, and then there were 2 other notes and bonds of the company that had different rates. And this is why knowing which ones you get to take first is important. So in terms of selecting the appropriate interest rate, for the portion of the weighted average accumulated expenditures that are less than or equal to any amounts borrowed specifically to finance the construction of the asset, we use the interest rate incurred on the specific borrowings. So I believe that was 14% on the specific debt. So that 14% will get applied first to the $250,000. That was only a $200,000 loan for the specific equipment. Now, the portion of the weighted average accumulated expenditures that is greater than the specific amounts, that's going to be $50,000 in our example. We use a weighted average of the remaining interest rates that we have on debt for the company. So those were the note and the bond payable, which I think were actually 14 and 10. The specific debt was 12. I'm sorry, I said 14 a second ago. So now we're going to move into the interest cost during construction. So compute the actual and avoidable interest. So the actual interest that we incurred was the $200,000 specific debt for $200,000 that was at 12% rate, which means we incurred $24,000 associated with that specific debt. So that's going to be capitalizable. Now, the next piece, our general debt was $500,000 at 14% and $300,000 at 10%, which gives us a weighted average of 12.5%. Now, that's just the total costs over the total amount of debt. So it was, if you do the math there, the total interest costs on those debt was $100,000, borrowing on $800. That's 12.5% interest. So 12.5% is going to end up being applied to the $50,000. 12%, the specific debt, is going to be applied to the $200,000 that it can be directly linked to the specific debt for the specific equipment that was being built. So our avoidable interest is the 200 times 12%, which is $24,000, and the 50,000 times 12.5%, which is $6,250. So our total avoidable interest is $30,250. That's our avoidable interest. Now remember, it's the lesser of the actual or avoidable. Well, our actual interest was $124,000. Our avoidable interest was $30,250. So obviously avoidable is lower. So we are going to capitalize our avoidable interest. To do that, our journal entry is to debit the equipment. That's increasing the value of that equipment, and crediting interest expense. We were taking it out of interest expense for the period because in theory, when we paid the interest, it was a debit to interest expense and a credit to cash. And now we're taking it out of interest expense for the period and we're sticking it into the equipment. So we are capitalizing it into the equipment balance. Now, that is how the interest costs are going to get pulled together and get capitalized in. So that pretty much wraps up interest costs. And that kind of wraps up this section. So when we come back, we're going to be dealing with understanding accounting issues related to the acquiring and valuing of plant assets. Bring tools. So I'm going to take a look, get the chain back on, and try to figure out why. This has jumped off a couple times now. So I'm going to try to figure out what's causing this, and we'll work from there. Well, that could be what it is. It's full of debris. So I was cutting back a bunch of bamboo in the meantime, and it looks like it just got caught in there, and it kicked off right as it comes, probably right as it comes into this channel. There's a channel that it cuts into right there, and it probably jumped out. So I'm going to clean that out and get it back up and running, make sure the track's clean the whole way around, make sure there's oil on it, and get it all put back together.